of incremental reasoning. We'll look at the concept of opportunity cost. We'll look up at contribution, time perspective, time value of money, that is discounting principle, and equimarginal principle. Now, while we discuss all these principles, you may understand that when we talk about economics, right, as a discipline or as a subject, sometimes, like I said, invariably, when we are using or applying economics, we tend to use so many of these concepts already, right? Or you might be so well aware of these concepts already that, while I am discussing, most of you can relate to the same concepts, understanding from your own examples, understanding from your own perspective, how you've been making, purchases, or how you've been, making your decisions around buying something as a seller. I mean, if any one of you owns a business, you will also understand that some of these concepts you are actually been applying into your businesses already, into your work already, and you've been able to make such rational decisions even without actually having to understand or having to absorb each and every of this concept. All right. Okay. So we'll look at incremental reasoning. We'll look opportunity cost, right? Let us start with incremental reasoning. Now, the two basic concepts that we discuss in incremental analysis are the incremental cost and incremental revenue, right? Now, how do we actually define incremental cost and incremental revenue? Now, incremental cost may be defined as the change in the total cost as a result of change in the level of output or investment or other needs, right? So, as the name itself is suggestive, incremental is increased and cost is the money that you spend. So sorry. Yes. So my question is, some of you might be seeing, seasonal demand for your products or services. For a simple example, I'll give you an example. So if you happen to be, in the businesses where you are selling specific products like wool products or silk products, right? You would see a sudden boost in the demand for your products in the colder regions during the winter season. However, during the summer season, you may have to give discounts, right? In winters, what products you might be selling at full MRP, you might be giving them a discount during the non-peak season. Am I right? Now, while you are doing that, I am sure during your peak season, you must also have faced a situation where you might have seen a high rise in the demand for your product, right? You must have seen, suddenly demands boosting up, and you may be you may be calling your supplier for additional raw material. You may be calling your if you are the final seller, you may be calling your manufacturer and partners, right, for supplying you additional units. Now, I am sure the cost that you spend on these additional units is little higher, right, than the cost that you would normally spend during your manufacturing cycles, right? Now, these costs are your incremental costs, right? Why are these your incremental costs? Because these costs have changed your total cost because of an increase in the output. Now, suddenly, what has happened? More and more number of people are demanding your products, and your stock, or the current number of inventory or units that you are holding may not be able to suffice it, right? So, in that case, what you do, you procure. I'm saying that whenever you have additional or incremental costs that can come as a result of any increase in the change in the level of output or investment, that is incremental cost. And opposed to incremental cost, when this change comes in the total revenue because of any change in the output or price of the product, is incremental revenue. That means you're earning more money, right? Maybe because of the change in price of your product or change in the level of output of the product. So the predicted sales and the actual sales have a huge difference, and the additional inventory that you've sold, you might have sold it at the exact cost plus profit, rather than giving any additional discounts or making any offers, etc. Now, in such a case, your price becomes an attractive figure, and it attracts more revenue for your organization. Now, use of incremental reasoning. Now, somebody might ask that, okay, there are these concepts which are quite basic to businesses, quite basic to, these are actually basic in nature. When you have high demands, you'll have to fulfill those demands by procuring more raw material, by spending more on the output, and your incremental cost might increase. Similarly, when you have higher sales, or you have better demand, or you have higher price of your good, definitely you'll be earning more revenue, which will result in incremental revenue. But then what is the use, or what is the use of this incremental reasoning for managerial decisions in economics? Now, while making a decision, as a manager, if you are the person who is responsible for making such decisions, you will always determine the worthwhileness of a decision on the basis of the criteria that your incremental revenue should always exceed the incremental cost. Now, for example, I said that suddenly there is a spike in the sale of your product and higher units are demanded, because of which you have to keep more inventory. Now, in keeping more inventory, you are spending a little higher, because on a normal day, you would pay for 100 units for one truckload, but right now you only need 20 units and you're paying for a full truckload for 100. So definitely you are spending more money. But is it worth spending this money? Right? So as a managerial concept, when you have to think from this economic perspective, you will always measure the two. So if I'm spending additional on these 20 units incremental cost, should I actually be, spending this money or not? If the answer is that your incremental revenue, IR, is higher than your IC, incremental cost, then you definitely should spend and should make a decision of, credit worthiness of your particular, uh, decision, right? So finally, you take that decision. Finally, you make a choice that yes, you will use that concept. You will include that monetary concept to take a decision that I am going to spend additional on 20 units, because the revenue um, that you are going to earn is going to be much higher. Marginal concept and incremental cost concept. Now, marginal is for any additional unit. Okay, for any additional unit, the money that you're going to spend is marginal, right? So that means if you're making 20 units, the 21st unit that you make, the cost that you spend on that 21st unit individually, that is N21 minus N20, is your marginal cost. However, incremental cost might be a sum total of all the costs. For example, to make 20 additional units, right? You may not be spending a lot in the fixed cost, but definitely you will be running your machinery additional time. You will be procuring more raw material at that point of time. You will be spending higher on transportation in case you are taking care of your own logistics. Even if you are not, you will be paying a third party for that, and so on, right? So incremental cost is any cost which is happening over and above, right? The invested amount which you had thought for your entire manufacturing or your entire production, right? Incremental cost, does it mean any immediate cost involved at the time, or is it per cost? No, I wouldn't say it is per cost. It is any additional cost, right? That might come up, which could be both in the fixed or in the variable, or fixed plus variable will be counted over here. Marginal cost is more specific per unit cost, right? So if I make a 21st unit out of after manufacturing 20 unit, the cost of that 21st unit will be my marginal cost. But suppose I make 40 additional units, right? And I spend money on those 40 additional units, that will be my incremental cost. But if I determine and break those 40 units again into individual costs, that will determine my marginal cost, right? So yes, you've got the concept right. Moving ahead. Now, let us see this. Let's quickly see this example. Okay, like what I said. Suppose you are a manager and you are asked a question that in our organization, should we spend this money or should we not spend this money? Okay, so let us see. Your firm gets an order, right? And in this order, you're going to earn an additional revenue of rupees 2,000. Okay, let me use the pen so that I can illustrate it better to you. Okay. Now, you are going to earn an additional revenue of rupees 2000, right? And this order is over and above the number of units you were going to manufacture in your manufacturing cycle. Obviously, you have methods of determining that also. Now, in this, the normal cost of production for any order that you have is 600 rupees spent on labor, 800 rupees spent on material, 720 rupees spent on overheads. Selling and administration expenses is rupees 280. So your full cost, right, on the production order at a normal level is rupees 2400. Okay. Now just imagine this second scenario is not there right now. Okay, just for once, keep it out. Now, in a normal setup, your full cost comes to 2400 and you are going to earn a revenue of 2000. Would you or would you not procure or go for this order? Will you take this order or not? Is it advisable or not? Answer why? Because you're going to spend 2400 rupees, but you're only going to earn 2000 on it, right? So if I see the normal scenario, this answer as a manager I will take and a route of saying no, don't procure this order. We're not going to take this order because we're going to make a loss of 400 rupees. Am I right? My loss would be 2400 minus 2000, so I'm going to make a loss. So don't make it. That's how I would think in a normal situation. However, what we need to pay attention over here is there is a additional revenue of rupees 2000. So this is not your actual revenue. Your actual revenue is different, and whatever your actual revenue is, you're going to earn additional 2000 on it. Okay, so assuming that you cover these costs up, the 2400 rupees plus profit you have already covered in your normal order. And now this order is going to give you 2000 additional, but that is not the only criteria. You do have to spend something additional, right? So if my normal procurement processing cycle is for 100 units, and I'm spending 2400 rupees on making those 100 units, where I may be earning just imagine 3000 rupees. That's my normal cycle. Normal cost 2400 for 100 units, normal revenue 3000 rupees for 100 units, right? But this time, my buyer has said that he doesn't need 1000 units, he need 1040 units, right? And for giving additional 40 units, he's willing to pay me rupees 2000 additional. Now I need to calculate what cost I'm going to procure if I have to manufacture these 40 units additional to what has already been my cycle, manufacturing cycle. Now, to calculate these additional costs, right, due to the new order, we will break this cost up and we will divide them into the various heads that we are going to spend on. For the additional 40 units, I'm going to spend rupees 400 on labor, 800 on materials, 200 on overheads, right? In this case, if you see, my selling and administration expenses are nil in this cost. Are nil over here. Why they may be nil? Because I may have already paid my rent for the month. I may have already paid, all my people for the months. So all the additional costs that I'm spending adds up to rupees 1400. Now, I'm going to earn a revenue, additional revenue of 2000, and I'm going to spend rupees 1400 on earning this additional revenue. Do you now, as a manager, advise me to process this order or not? Is it now advisable to process the order? Definitely, yes. Your answer is absolutely correct. It is advisable to procure this order. Why is it advisable to process this order? Because I'm going to spend 1400 and I'm going to earn 2000 by spending those 1400. So my net profit comes out to be rupees 600, right? So if I see it in a first criteria, not supposing the incremental concept, I'm not applying incremental concept. Without incremental concept, I would have made a loss of 400 and it was not advisable to proceed. But looking at the incremental concept, I make a profit of 600 rupees and it is advisable to accept such an order and proceed with the procurement, right? So this is how, where you apply the process of incremental reasoning. Okay. So now, when we talk about incremental concept, always understand a course of action should be pursued up to the point where its incremental benefit is equivalent to incremental cost, right? So if you are talking about maintaining relations, if you are talking about, being able to take up better orders or build relationships, then in that case, up to what extent you should take the course of action? Only up to the extent where your incremental revenue is equal to the incremental cost, right? So it should either be more than actually or equal to. So till the time your IR is more than equal to IC, you can take the decision of going ahead. Otherwise, don't go ahead. Okay? That's how you use this concept. Now, moving to opportunity cost. So, opportunity cost therefore represents the benefit of the revenue foregone by pursuing one course of action rather than another, right? For example, the opportunity cost of the funds employed in one's own business is the amount of interest, right? Which he could have earned had these funds been invested in the next best channel of investment. So the opportunity cost of using an idle machine is normally zero, right? As if you want to use it, you may have to sacrifice some of your opportunities to do that. Okay, I'll give you a simple example, right? Now, when I'm talking about opportunity cost, suppose after completing your MBA, you get two options. One option is a company offering you a full-time profile, which will be, like 12 lakh per annum. Just assume that. Another company which is offering you a part-time profile, right? That too at a remote kind of an opportunity. And maybe the working hours are less, but you will be earning 9 lakh rupee per annum. Okay. Now, if you choose the first option, your opportunity cost will be 9 lakh rupee and the time that you might have saved. If you choose the second opportunity, that is the part-time job with 9 lakh rupee package, remote role, your opportunity cost is 12 lakh. Because if you would not have got this opportunity, if you would not have chosen this opportunity, you would have taken the 12 lakh rupee opportunity. So, what is opportunity cost? It is the cost of your next best alternative. If not this, what was my next best alternative? If my next best alternative was 12 lakh rupee job, that's my opportunity cost because I'm doing the 9 lakh rupee job. If I'm doing the 12 lakh rupee job, my opportunity cost is the 9 lakh rupee and the time I could have saved, right? Normally, time cost is taken into account in a different system. Here we'll only see 9 lakh and 12 lakh as an option. Now, this 9 lakh rupee profile is also saying that, you have some options of getting the company stocks. And you feel that, company stocks are more profitable than a 3 lakh rupee additional salary. And you choose this one. That becomes your 12 lakh rupees becomes your opportunity cost in that sense. Okay. So whichever is your next best alternative, the other one is your opportunity cost. So it includes both your explicit and your implicit costs, right? Now, what is explicit cost and what is implicit cost? The explicit costs are those which are recognized in your book of accounts, which could be the payment for your labor, your raw material, etc. And implicit or the imputed costs are the sacrifices that are not recorded in accounting. For example, the cost of capital supplied by owners of the business. Now, as business owners, I'll explain you how this works. So, if you are the business owner, okay, for you, your explicit cost is everything that you can list in your book of accounts. The salaries that you are paying, the raw material costs that you are incurring, the fixed costs you are incurring, etc. But what is your implicit cost? Suppose you are spending, 12 hours a day and you are sacrificing a lot of things to do that. Maybe you're not spending time with your family. You are maybe cutting down on your leisure activities, right? And maybe you are getting some money from your own pocket and spending it on your business. All these are your implicit costs because these costs you cannot record in the book of accounts, right? So opportunity cost can include both explicit as well as implicit, right? Next concept is contribution. Now, Contribution will tell us about the contribution of a unit of output to the overheads and profits. So what is the contribution of a of one output to my overall overheads and profits? It helps you in determining the best product mix when allocation of scarce resources is involved. Now, taking the same example of manufacturing. So suppose I have my own textile manufacturing business. And in this unit, what I do is I manufacture t-shirts and I manufacture shirts. I sometimes also manufacture, some leisurely products like caps, etc., because I have a lot of raw material left, which I utilize over there. Now, uh, suppose I have to make a decision on whether to expand into a product line, and I want to relook at my product mix. So my product mix right now is t-shirts, shirts, caps, and other accessories. Now, to make this decision of where can I save my costs so that I can expand into another unit, I will try to determine the best possible contribution that each unit of output is making to my overheads and profits. Now, while doing this analysis, suppose I come to know that, say, on the t-shirts, I make the maximum coverage on overheads and I'm making the maximum profit. And maybe the caps are not, selling that much, and their overall contribution to overhead and profit is either zero or even negative or low. Now, in order to best set my product mix, I can either take a decision of eliminating my cap unit altogether or maybe spending lesser amount energy and resources on those units and using those units elsewhere into putting them back into t-shirts, investing more on the t-shirt designing, investing more on the t-shirt raw material, etc. Right? Now, why this concept of contribution is important, especially if you think from a business perspective, as business owners, right? When you have to make these decisions, they can directly coincide as to where you make highest profits and where you may not, especially when you want to pitch in your businesses, when you want to expand your businesses, when you are looking for expansion of your product lines. It is very, very important at that point of time for you to have clarity, right, on whether you want to maintain the same product mix. Are you thinking of cutting down on some units, or are you thinking on curtailing or keeping your costs low on some additional units you may be thinking of? All right. Now, it will also indicate whether or not it is advantageous to accept a fresh order or to introduce a new product or to shut down or continue with existing plant, etc. Like I just said, okay. So suppose suddenly you have now realized that your cap unit isn't a very profitable unit, and you are rethinking on whether you want to spend on this unit or whether you want to proceed with it or not. Now, in the meanwhile, suddenly you get an order for caps. Now, what has happened, because you were not making much profits, you have reduced your designers, you have reduced your labor, you have reduced your raw material that you are buying on caps. Now, whether you should accept this fresh order or not will be based upon the contribution margin. If the contribution margin is negligible, you can decide to not process any further orders or take fresh orders or introduce any new products in this line, or you can even plan to shut down the production of caps altogether. Okay. And your unit contribution is the per unit difference of incremental revenue from the incremental cost. You know that, right? So my IR minus IC will give you your unit contribution. So if I have made 40 units and I have spent 1400 rupees, right? What is this amount spent on one unit? It will be 1400 divided by 40, and the revenue that I have earned is 2000 divided by 40. So if IR is more than IC, your unit contribution is positive. If IR is less than IC, your unit contribution is negative. And you should rethink, right, whether you want to continue or you want to discontinue. Next comes the time perspective. Another very, very, very important concept here in economics. Now, when we talk about time perspective, okay, economics is something that will help you in determining and understanding Lot of forward processes as well. For example, when you start a business, right, you don't start a business thinking about what it is today. You do plan for your future, right? You think from the perspective of how this business is going to move ahead. What are the profits I may be able to make on this business? Will I or won't I be able to make any profits on this business, and so on, right? So you take decisions based upon the time perspective. So economists often make a distinction on the basis of time perspective, and they're divided between the short run and the long run. Now, name itself is suggestive. What is short run? For a shorter duration. What is long run? Where the time span is longer. But in economics, it is not about only time span. It is also about considering your fixed and variable inputs, right? So short run is a time period in which some of your inputs can be fixed and they can't be altered. Like, I'll give you an example here. So today you decide to start a business, okay, and for this you have rented some space. Say the rent that you are paying is amount X for a month. Okay. Now, in the short run, whether or not you make products, you are going to pay this rent. Take the example of COVID, right? In COVID, though people had to shut down their businesses, right? But they were still paying the rent to own that place. Am I right? You had you might have seen situations where you had to shut down your work temporarily, but you were still paying some costs, right? Like rent, like maybe some basic electricity running bills, water bills, etc. Now, these are your fixed costs. These are those costs which you can't alter. You may produce something or you may not produce something. You may do some manufacturing, you may not do any production at all, but still you can clearly distinguish that this is my fixed cost. And every time you start making a product, you will incur some variable cost. What is variable cost? Variable cost is the cost of labor, the cost of raw material, the cost of transportation, the cost of fuel, etc. Right? So all the inputs which can be altered, their quantity can increase or decrease depending upon your requirement. But in fixed input, the quantity cannot increase or decrease depending upon your requirement, at least in the short run. But in the longer run, all your inputs become variable by nature. This is what economics says, that in the long run, right, because your business has incurred some longevity, your business has incurred, some perspective where it can continue to run profitably. You can expand the space from one shop, you can buy another additional space just nearby land you can procure. Because you procure a nearby land, maybe you will spend more on electricity, you will start spending more on your fixed input. So no input remains fixed now. In the long run, all your inputs become variable. So all of them can be changed. Now, economists try to study the effect of policy decisions in different variables like prices, cost, revenue in the light of these distinctions, right? So, this is your time perspective: time, short run, and long run as per economics. Short run means you have fixed and variable. Long run means all your inputs become variable, there are no fixed inputs. Next is the discounting principle. Discounting principle, the concept of discounting is a futuristic concept, right? Now, it is based on the fundamental fact that a rupee now is worth more than a rupee earned a year after. That is because if we look at it from the perspective of logic, it is because if there is inflation, that will bring down the value of your rupee, right? So inflation is inevitable, right? I'll not get into the depth of this. Why? Because this is more about the macroeconomics. But there is a concept of inflation, right? So if your rupee worth today is able to buy a commodity for that price, tomorrow you may not be able to buy. I'll give you a simple example. I'm sure most of you have been to McDonald's, right? Now, if you visited McDonald's earlier, you might have seen their basic burgers used to cost something as low as 25. Now, do you find any burgers on their list which is worth 25 rupees? Now, no. Right? Definitely not. That is because of the discounting principle. So Your 25 rupees some years back would buy you one burger in McDonald's. But today, because of the discounting principle, the rupee loses its value every year. Okay. And there are multiple macroeconomic factors because of which this is happening, one of which is inflation. There are others as well. There are a lot of other factors. Okay. Now, as a result of this, the value of 25 rupee today is much less than the value it was some years back. Right? Now, unless you are discounting these returns to the to find their present worth, it is not possible to judge whether or not it is worth undertaking an investment today. Right. So, for example, I'll give you a very simple example. Suppose you have a sum of rupees 100, which is due after 1 year, right? And let the rate of interest be 10%. We'll just quickly look this up. So let the rate of interest be 10% in this case. Now we can determine that the sum to be invested now is as to produce the return of rupees 100 at the end of 1 year. So the present value of the discounted value of rupees 100 in this scenario should be 90.90. Now, this same reasoning, can be used to find the present value of longer periods. Now, a present value of rupee 100 due 2 years later would be 82.64. Thus, we can write the stream of income spread over the years, right? Because of n number of factors, considering macroeconomic factors are changing. So you will see year after year, rupees 100 is going to lose its value. After 1 year, it will become 90.9. After 2 years, it will become 82.6 and so on. This will continue, right? This decline in value will keep continuing because of the discounting principle. And this is where, how you have to take your investment decisions. When somebody says that, how much amount should I invest, right? Or how much money should I put? You have to think from that perspective. For now, you may finally, the equimarginal principle. Now, the law of equimarginal utility states that a utility maximizing consumer distributes his consumption expenditure between various goods and services in such a way that he consumes the marginal utility derived from each unit on expenditure on various goods, which remains the same. Okay. In a very simple manner, let me put it. Suppose a firm has a total capital of 100 million, right? So 100 million is the amount which the firm wants to spend on three projects, project A, project B, and project C. Now, each of these projects require some unit of expenditure, say 10 million each. Okay. Now, if I want to invest in project A, it will take 10 million, in project B, 10 million again, and in project C, 10 million again. Okay. Now, I have to take a decision, right, of how do I determine the marginal productivity. So, unit of expenditure remains the same, that is 10 million, and marginal productivity for project A, the first gives me 50. For project B, the first unit gives me 40. For project C, the first unit gives me 35, right? For second unit, obviously, because of law of diminishing marginal utility, these values will come down. For next one, they will be further down. And finally, you will see here it has become 0 for the fifth unit for project B, right? It will become 0 maybe on the sixth unit for project A as well as project C. Or maybe for project C, it may become lesser at the seventh unit. Now, an as a manager of such an organization, if I have to take a decision on which project should I keep on spending more money, the equimarginal principle will suggest that a profit maximizing firm will allocate the resources in such a proportion that the firms had limited investable resources and the resources have some alternate usage. The investment in various alternative uses the subject to diminishing marginal productivity or return. So MPA should be equal to MPB, should be equal to MPC, should be my net marginal productivity, that is MPN, right? And this is normally how I will proceed. Okay. Now, this principle will suggest that whatever your available resources or inputs are, they should be allocated in such a way between the alternate options that the marginal productivity from various activities should be equalized. That means, till what time should I invest in project A? Maybe till the fifth unit. If I have to answer this question for project B, it should be till fourth unit. If I have to answer this this for project C, maybe till the seventh unit, right? As soon as I see a value of zero, I should stop investing more money, and this should be my last unit on which I should be willing to spend. So for project A, if I'm spending money for, you know, 5 units, for project B, I'll spend money only for 4 units, and for project C, I'll be spending money for 7 units. This is how I can break it. Okay. Okay. Now, a close interrelationship between management and economics, that is managerial economics, the subject of our concern here, this has led to development of an altogether new field, which is of managerial economics. Now, economic analysis is required for various concepts, which could be demand, profit, cost, and competition. Managerial economics is considered as economics applied to problems of choice or alternatives and allocation of scarce resources by the firms. Managerial economics is a discipline which can combine the economic theory with managerial practice, and it helps you in covering the gap between the problem of logic and the problem of policy. Okay, so you know there is a policy, there is a system, but there is logic also. You use your logic when you make your decisions. So this subject offers powerful tools and techniques for your overall managerial decision making.